Hello, everyone. Welcome. Thank you for joining the Financial Modeling and Planning in Uncertain Times webinar. My name is Thomas Ironstone, and I'm the Manager of Corporate Renaissance Business Intelligence and Corporate Performance Management at Corporate Renaissance Group in IDU North America. I'm also joined by my colleague, Kevin Phillips, CEO of IDU. Hope you're all keeping well during this unique time. We're thrilled you could join us today and plan to provide you with a lot of great information and insight. A few housekeeping items before we get started. Today's presentation is being recorded. We'll be sending the recording and slides to all attendees this week so you can share and rewatch. We also want to have your questions throughout the webinar, so we'll answer them at the end. We've allocated 15 minutes at the end of the webinar to answer all questions that you might have. So please make sure to use the GoToWebinar panel. You can input your questions and we'll make sure to answer all of them at the end of the webinar. So the agenda for today's presentation, we're going to be giving an overview of idu-Concept and Corporate Renaissance Group as organizations. And then we'll be getting into some content to set the stage for the meat of the discussion for idu-Concept. So in context of today's world, we'll be talking about FP&A in a dynamic world in the context of COVID. Then we'll be giving a technological overview of idu-Concept. We'll be going through key software features for remodeling and planning, and we'll be going through some examples, and of course we'll have questions for, at the end. Corporate Renaissance Group, we've been around for 30 plus years. We are a Microsoft Gold partner. We partner with leading business applications from Microsoft to idu-Concept, and really what we're looking for are really true best of breed solutions that can help meet all of our clients' needs regardless of the scale. So we're expertise across ERP, FP&A, BI, and talent management, and much more. Our team, we have individuals that are both expertise in finance and technology, and of course certified in the systems that we work with, to ensure that we help understand the business challenges and help implement the solutions in the best fashion possible. idu-Concept has been around since 1997, also a Microsoft certified gold partner. This solution is very innovative and has been recognized by Gartner, and it's also been recognized by G2 Crowd as one of the top corporate performance management platforms. And this solution is fast growing with over 340 customers worldwide and over 33,500 users globally. This solution you'll see, as Kevin will talk to later, can be used across all industries, and this tool excels and it specializes in budgeting, forecasting, and management reporting. So of course, regardless of the industry or the companies of the folks that are attending today, some might be new to idu-Concept and some might be existing clients. The key thing here is trying to understand what's happening in today's world. So obviously COVID-19 has impacted us all regardless of company and organization, and it's affected us in many ways. What we're seeing a lot is the way we do business has been impacted. Of course, if we even think from retail as an example, going from bricks and mortar to having to move rapidly to e-commerce. And this is not just retail, we see this in fast food services as well, needing to ensure that they have e-commerce capabilities. And it's also changed logistics and much more, and I'll talk a bit about that. We've also had impacts on, regardless of industry as well, is some of the impact on availability of raw materials from suppliers. So we've had to adjust, make changes, find alternatives, or even potentially not deliver on potential demand the remaining demand that we might have. We've also had impacts on the workforce capacity due to restrictions in the way we do business. So even if the demand of our products and services has gone down, as an example, even sometimes being able to deliver on what's been promised, organizations are trying to adjust to meet those needs in terms of the restrictions. So having to pivot and find other ways to make sure that they can still deliver on those demands. And for global organizations who are working across many different countries, whether it's selling into different countries or procuring supplies and raw materials from different countries, they might also be impacted by fluctuations in foreign exchange. That's affected many economies globally. So treasury obviously is a key consideration as well. So as you can see, this is just a short list, but the way it's affecting our organizations globally, it's having a very dramatic effect. So I'm going to take time for it to take a quick poll. I will launch it on on the screen in a moment, but really what we're asking first is, before COVID-19, what was your frequency of forecasting? So I'm distributing the poll right now, so you'll see that there's 4 options for biannually, quarterly, monthly, or not applicable. And this is before COVID-19. All right, so we're sharing the results. It's approximately 67% we're doing it monthly and 33% we're doing it biannually. So that seems fairly common for most organizations. Now, out of curiosity, what were folks doing after COVID-19? What is the expected, there's another poll now, same questions. After COVID-19, what is the expected frequency of forecasting or reforecasting? All right, so I'm going to share the results. So it looks like it's an even split between quarterly, monthly, not applicable. So there was a big shift from biannually. It looks like some individuals are doing it more frequently and some maybe not even able to do it at all, potentially because of challenges. So that's really interesting, because as we'll see, with the demand of having information and understanding the impact on the way we do business, as financial leaders within the organization, we're expected to give guidance to the organization. So when we're thinking of all the different business leaders, they'll be asking us, what does our forecast look like? How is this impacting us? So as for the additional things I was talking about before, changes to our demand, changes to from our suppliers, impact on our workforce, it will have an impact on our forecast, and the business leaders need to know what that impact looks like. So as you can expect, there's increased internal demand and frequency of doing forecasting, scenario planning, and reporting. We need to understand what the impact is going to be on cash flow and treasury. This is going from maybe doing this forecasting where, as we saw in the polls, some before were doing this biannually as an example, or maybe some weren't even really doing it at all. But now it's important that we do this more frequently, because it's almost a week-to-week basis where we're trying to understand how the forecast is changing and what impact will that have on our bottom line and on our cash flow. The other thing is, what levers do we have? What does the pipeline look like? What are we committed to? These are all important things, especially as we're going through and trying to understand the impact. So as I was mentioning, the frequency has gone up, and this, as we saw in the poll results, the frequency of forecasting has gone up dramatically. So being able to do the scenario planning, reforecasting, and reporting has gone up dramatically. Because as the information comes in on a week-to-week basis, we need to know how to be able to pivot, what adjustments that we have to make, what levers do we have to be able to adjust to make sure that that we're giving the business the right guidance on what we need to do. So in the context of reforecasting and scenario planning, how will this global impact affect our forecast? So there's a few things that we actually need to look at, and this is a short list, and there's obviously other areas, but the big one is our demand. So obviously, demand for our products and services, regardless of industry, will have been impacted in some way or another. So this is critical. And what we've been advising to our clientele is to assess what the customer base is as far as our different customer channels that we work in, whether it's B2C or B2B, understanding what the impact is. So on just say a B2B basis, we might want to review what industries our customers are in and assessing what the short-term and long-term impact of the current effects are. For example, if we're overexposed in one particular industry, as an example, like let's just say media, where we know that movie production has gone down. So if our client base is primarily in media, might have some dramatic effect. Sports and entertainment as well is another area. So understanding what our impact is based on our customer base and understanding what channels they're in, that's definitely something that all organizations should revisit to understand what the impact will be. From a supplier standpoint, so if we're in distribution or for manufacturing, whatever it might be, understanding our supplier base. Are we over-reliant on one particular supplier? What regions are they in? Are there any issues with availability of supplies and raw materials? Obviously, this will affect even our remaining demand to understand if we're able to deliver on that. So doing a full review to understand when we're doing our forecast to say, even though this is the demand, will we be able to deliver on that? Because that will in turn have an automatic impact on the revenue forecast as well. From a capacity standpoint, we talked a bit about the supply side, but on a workforce side, this is also very critical. So determining if we have any constraints from the workforce based on the demand that we have. So as we know in today's world, there's a large work from home initiative that is going on. And whether we're in the service industry or whether we're in manufacturing or whether we're in distribution, whatever it might be, different regions of the world have different ways that they're adjusting to the restrictions. And so if this has naturally had an effect on our capacity to deliver, when we're doing our forecast, we really have to assess if, even if our revenue targets were originally X level, X volumes for the year, we know naturally there's going to be some reduction on that because of the capacity from whether it's manufacturing, distribution, regardless of the industry. So that definitely has to be factored in because that's going to be a natural limitation on the ability to deliver. And the last item is foreign currency, as I was speaking to a little bit earlier. So whether it's on the sales side or supplier side, this will have a dramatic effect on Treasury. So understanding what the FX changes are and how that might evolve over time to understand, as an example, what's our exposure to US dollars, what's our exposure to euros, what's our exposure to rand, what's our exposure to GBP, whatever it might be, and understanding how those fluctuations are happening and what do we need to have on hand, or what will we have on hand, so being able to evaluate the cash flow for that, very critical. So now understanding what the impact is just from global situation on our demand, on our capacity, on FX. Now the next question is understanding how it's affected us. Now we need to do some scenario planning. What levers do we have? So with the forecast in mind, what can we do to potentially help the situation? So as we're building out our forecast models and doing our modeling, there's some things that we might want to look at. One of those which might be our suppliers. So when we're thinking of obviously the cash conversion cycle, the current situation has had a dramatic impact on managing cash flow. So being able to reach out to our suppliers who are fully aware of the current situation and see if there's an opportunity to negotiate credit terms with suppliers. This is definitely that we're seeing definitely our clientele reach out to their supplier base, seeing what the credit terms are, seeing if any relief or adjustments can be made, obviously keeping them in business as well as supporting our business. There's also the opportunity to look at value alternatives. We might have been heavily reliant on one supplier. Maybe we could look at other suppliers and alternatives on the market. And of course, we need to make sure that we're adjusting our procurement demand of those supplies based on the revenue forecast. So as we're going through, we're understanding our revenue forecast, we need to make sure that our procurement plan reflects the demand, because it's naturally going to be affected. So making sure that the procurement officers know how the demand is going to impact the requirement for supplies, because that will need to be adjusted. And that will naturally have a positive impact to help plan out our cash flow. On the customer side, the receivables. Naturally, again, cash flow is still a concern. So being able to look to our customer base, what services have been delivered, what products have been sold, are there any accounts that are still remaining outstanding? So here's an opportunity to potentially reach out to customers. Is there an opportunity from our customer base to offer early discount options for those customers? So if they pay early, then potentially offer a discount. And so again, that could help organizations' cash flows, and it's an alternative that some organizations that are looking at as they're doing their forecast to see what the impact will be on cash flow. On a workforce side, obviously many organizations attending the webinar today are in different regions of the world, and different governments are offering different subsidies and programs that can help us assist organizations. So there's some things that might be available out there. And to that extent, for what's available out there to help manage our cash flow, there's opportunities to assess amongst your organizations to see if there's any compensation strategies that can be temporarily deployed to help cash flows. Maybe it's temporary salary deferrals as an example, and that would obviously help cash flow in the near term. Another thing that we might want to look at from our workforce planning, so as we're doing our budget, we're doing our workforce planning, we might want to look at potentially delaying planned new hires, or maybe even revisiting it altogether. So this is critical for many organizations, because especially if you're in the professional services area where employees make a large portion of your overall budget, this is something that many organizations need to review and see if there's any strategies that we can do from a forecasting standpoint to see how that can impact our forecast. Many organizations as well are taking the opportunity to reach out to their landlords. So if they're not currently, if they don't own the land and property that they operate in, if they're renting, there's an opportunity to discuss with the landlords and property management companies to see if there's opportunity for a temporary rent relief, because this can help the organization in many different ways, and we do see our client base taking advantage of that as well. And finally, and not the last item, is lenders. So being able to negotiate more flexible financing terms. In different countries, different financial institutions are offering some opportunities to renegotiate those terms, and this can also help with cash flow in the near term. Another thing that we see organizations doing, and this is a big one, is reviewing what projects are on the table. So we might have made a plan for the year. This implied certain projects were going to happen. So there's certain projects that are, let's say, critical to business operations, which might still need to be done. So there's opportunity for organizations to reach out to key vendors that they're working with on those projects to say, is there anything that we can do to maybe delay payment for a short period of time, just until things start getting going again, because we need to make sure that these critical projects do happen. And for areas where that cannot happen, there's where we might look at delaying or canceling non-critical projects. Of course, there's new projects that are that might have landed in our lap simply because of the state of the world. So the new way of doing business. And for these projects, they could be anything from e-commerce. Of course, if no longer in the near term might have an impact on the brick and mortar type retail fronts, being able to move our operations to e-commerce. So that, of course, will be a project in itself to get something set up, and understanding what the financial impact will be to get it set up. And obviously that will have an ROI, because will again help make sure that we deliver on our revenue stream and demand, so we can continue to service our customers. As well, that we see affected is delivery and logistics. So there might be changes if we're going to e-commerce and we're going to delivery. If we don't have a logistic system that we manage internally, we might have to start looking at external suppliers to provide logistics. So that might be a project in itself to assess those opportunities, to see where we can leverage logistical companies to help us deliver on the demand through the new way of doing business. With work from home comes the need for new technology. Collaboration is huge right now. We're obviously using it today in the webinar, but we're also using it day to day for doing work and web meetings. Many organizations need to implement these types of technologies to ensure that that business continues, that folks, even though they used to be in the office connecting with each other, now being able to set up web meetings, chat with each other, share files, and make sure that work is still continuing on a day-to-day basis. The final lever that I'll discuss today is around products and services. So with the new world and the new way of doing businesses, we might start reviewing what products and service offerings we might have planned. So if we had planned to introduce new products this year before going into the year, now how things have changed and evolved, we might consider delaying some of those items that might be less relevant. And through this, there might be new offerings that our organizations can offer, new products, new services that are more relevant to our customer bases to help get them the things that they need. So definitely reviewing the products and services offerings to see what's more relevant in today's world, and what can be done in a short-term basis to help meet our customer needs. So as you see, there's many different levers that we have to consider and at our disposal as we're doing our reforecast. So as we go through this process, the key thing first to understand what is the overall impact and see what the forecast looks like. And then the next step is to see the scenario planning, the scenario analysis, to see what levers do we have, what things can we do, understanding what the impact is on the bottom line, understanding what the impact is on cash flow and treasury, and make those adjustments. So as finance leaders in our organizations, we need to provide this information to the business leaders. We have this expectation upon us, and we need to find ways to deliver this information. However, we know that in today's world, there's many things that we need to consider in our finance groups. So technology can be our friend. As we know, many organizations still heavily rely on spreadsheets. And while spreadsheets provide some flexibility, when we're trying to do this ad hoc analysis, understand how to flex the budget, do modeling, it can have its constraints, especially at this scale, and trying to do it more frequently. So we're spending more time, and especially in this time of need, trying to do administration and setting up these spreadsheets, and not enough time spent on analysis. When we're trying to get inputs from individuals, so obviously when we're doing our forecast, we need to get inputs from, say, the sales teams as an example, to understand how their base is affected. Participants are unclear of what's required from them, what they need to update, what they need to contribute. So we need to find ways to make that simpler for them so we can do the forecasting on a more frequent basis. We also have to make it easy for them to access, because if we're sitting around spreadsheets and files and they're updating it and they've updated a version that's old, and we're spending now more time as a finance team trying to figure out who updated what and trying to cobble it back together. So we need to make it easier for contributors to input those budgets or updated forecasts. Another thing is we need to make it more driver-based. This is huge. When we're thinking of modeling, especially in today's world, trying to understand the impact, we need to decompose our assumptions into volumes and rates as an example. Because if we're gonna have fluctuations, say in, as we're talking about FX, if we're gonna potentially have to maybe offer some discounts, or maybe we're gonna have an impact on volumes, we need to understand what those drivers are and how we can flex those to better prepare ourselves going into the coming months and year. Of course, the slow turnaround is a major issue as well. So if we understand folks are doing their day-to-day, and if they need to look to an email to download a file and make an update, we need to make that process a lot quicker. And as we know, in many organizations, I'm sure attending the webinar, trying to even just do the budget cycle is like pulling teeth. And so the turnaround for this can be quite painful. So being able to make the process easier for them so they can provide their inputs so we can update the forecast is critical. As well as updating the overall financial view. So whereas we're updating our forecasts, we need actuals to come in. If we're working in spreadsheets, we need the actuals to flow in as an example, but if we're manually exporting trial balances, dumping it into a workbook, cobbling together reports, this process can be very manual and time consuming. We need to make it a little bit more synchronized. So being able to pull it together in some type of technological solution that we're mirroring our financial results with our forecasts so we can get updated reports and makes the whole administration process a lot easier. So we can reduce the amount of time having to recreate those reports because everything's synchronized. We have our report structure set up. Our forecasts are linked to our budgets and linked to the actuals, and everything will be there for the business leaders to review and even do their own analysis. We're going to launch one final poll, and then I'm going to hand it over to my colleague, Kevin. So for this last poll, it's asking, what is the biggest impact to your original budget? So before going into this year, you might have had a plan, and as you're doing your forecast, what are the things that you're reviewing the most? Is it revenue and demand? Is your cost of goods sold materials? Is it your workforce? Or is it all the above? And so many organizations, as we know, are affected by this situation in many different ways. And there's things we need to reconsider as we're doing our forecasts. And just curious with the group what the impact is. And I'm going to share the results. So as you'll see here, it's sort of split primarily between revenue and demand. That's expected, whether it's we're B2C or B2B, different industries. We know it's affecting us in many different ways. And so understanding how that impact is, if demand goes down overall, what adjustments can we make? What levers do we have at our disposal to be able to still continue, stay in business and deliver on that demand? And then, of course, all of the above, of course, whether it's revenue, materials, workforce, it's just affected us in so many different ways. So hopefully with the levers that I talked about today, understanding what the impact is on your forecast and understanding how we can do scenario analysis, how we can do modeling, which Kevin will speak to understand as finance leaders what options and scenarios we can give to the business leaders to help guide the ship and keep us afloat through this through these times. All right, so that being said, I'm going to hand it over to my colleague Kevin.
Hi everybody. Excuse me for my Scottish South African accent, but I will go through things slowly and take you through things as I see it. Okay, the value of idu-Concept, I mean, these are really our sort of corporate goals, if you like, in many respects. I think the most important one, and the one which drives a lot of our development, is actually the fourth point. We're really about empowering non-financial managers in an organization. Now that sounds strange because I'm an accountant by trade, and we typically sell to accountants. The issue is that budgeting is a tool that finance understands, and it helps us predict when we need cash flows, when we don't need cash flows, what can be spent and what can't be spent. Non-financial people don't necessarily recognize that or understand that, and they often see the budget process as unrelated to them. If you don't empower them, if you don't get them to feel a sense of ownership around the budget, they will never take any accountability for variance analysis when you start looking at actuals. So a lot of what drives us is actually empowering those non-financial guys to take ownership. Okay, so idu-Concept is actually a composite solution. We deal not just with budgeting, but we actually try and focus around those non-financial managers in the space of budgeting, but also reporting. Then we also look at product customer budgeting and reporting, which is really your S&OP, your sales and operational planning. It's budgeting by customer, by product. We then look at asset management, because your departmental managers are not just responsible for doing budgets. They're also responsible for the assets that they have around them. So our asset management functionality allows us to get the end users to go and do asset verifications, to identify disposals or damage, to record additions to fixed assets. Obviously, the controller of all of that sits in finance, and the controller of all that is the custodian of the asset register, and they get electronic notification of changes so that they can maintain and update that. The adjustments module is a bit of a consolidation module, allowing us to do some financial consolidation transactions, and then we've got the financial modeling tool set. Now, financial budgeting is pivotal to everything, but budgeting can take a long time. And with IDU, we typically find our clients cut down their budget cycles literally from months down to weeks. Now, if we can cut budget cycles from months to weeks, that's great. However, a budget is still a bottom-up budget. It's completed by end users, and there is still going to be some form of time delay in doing that. The environment we find ourselves in now, we're having to reforecast almost on a daily basis because things change. We're looking at our mortality rates, we're looking at the impact of COVID-19. Are we on lockdown? Are we not on lockdown? Are we going to be released? What happens when we're released? The information about that is not available today. It changes tomorrow, and we're constantly getting inundated with new information. And that new information constantly is permeating through to us. So we need to be able to fine-tune the budget based on that input. Now, that's not a question of going and redoing the budget, because the budget process, even if it only takes 3 or 4 weeks, you haven't got 3 or 4 weeks to reflect those changes. And that's where our financial modeling tool set comes into its own. Because what we're doing there is we're playing in an environment where we start to build information based on assumptions. Just a little bit of technical overview. In terms of IDU, we run on a browser-based application, but that can run on-premise or in the cloud. It's entirely up to you. And we tend to redevelop the software on a very regular basis, so it's constantly getting new releases and adapting to new requirements. Our system will integrate with any ERP system. It offers multiple views of data, all that wonderful stuff that you can read on the screen. Again, one of the key things is the functionality around budgeting, around financial reporting, management reporting, asset management is all managed and owned and controlled by finance. Therefore, we don't see why the administration rights for our system should be maintained by anyone other than finance. So I think in 99.9% of our environments, finance are in fact the administrators of the system. They control security, who can do what, when, what access rights they have, etc., around budgeting and financial information. It is aimed for non-financial managers, so it is obviously easy to use. It is easy to manage, and it is quick to deploy. More about that just now. Just giving you a bit of background. Companies like yours that would use IDU, honestly, we pretty much play in every industry sector, and we've got some good brand names in every single one. The beauty of IDU is that we don't have to have vertical versions of the software. The vertical versions will mean that one version will get out of sync with another version. There'll be some functionality added in one which is not available in another. We prefer to have a single base of the software, and that base of the software allows us to actually distribute the product to all of these industry sectors. And everyone gets the benefits of new features and new enhancements. How you apply the functionality embedded within IDU is what differentiates one client from another. And then we've got quite a few clients around the system, around the world, and typically we've got very happy clients, as is reflected by G2 Crowd and Capterra rankings. So let me get back to practical stuff. I was talking about the budget, and I was talking about how the budget process can take a few weeks, and you haven't got time to adapt to that. You haven't got time to fine-tune a budget as new information becomes available. So what our financial modeling, or financial planning toolset really does is it looks to be a roadmap to assist you. Now, in any roadmap, in any plan, you need to start somewhere. So the first thing you've got to do when you try and build a financial model is have a starting point. That starting point is going to be a base set of data. Now, we would typically recommend that that should be the budget that you originally created, because that is a detailed budget. It's been built up methodically. It's taken a bit of time. People have given it some attention. They've applied their minds to it. It's a good starting point. What you then need to do is you need to define scenarios. Because obviously in a scenario type environment, it's a question of saying how many years in the future do we want to predict? Are we going to have a good, a moderate, and a bad version of our scenarios? Do we want to generate them all at the same time? And then the next thing we do is we define assumptions. Now, assumptions are completely separate from your scenarios and completely separate from your base data. Assumptions are things which allow you to say these factors will have an impact on our numbers, and then defining how those assumptions will interact with the accounts. And that's what we do when we start saying, well, let's take our base set of data, let's link accounts to that base set of data, and let's start to build that forward. So we can now start to see how accounts interact with the assumptions. And then obviously there's a great big button that recalculates everything, because at the end of the day, assumption-based planning is nothing more than a great big calculator, taking sort of raw data, manipulating it based on assumptions, and delivering a new set of financial information. Once you've got that information, you obviously review it. If you're not happy with what you see, then obviously you rinse and repeat. Rinse and repeat, that's really going back to your scenarios, going back to your assumptions, going back to your accounts, and determining are those accounts correctly linked to those assumptions? Should there be additional assumptions linked to accounts or none? Are the assumptions valid? Is the inflation rate that you originally had the inflation rate you really want to use? Do we change it? That's a perspective in terms of how you would look at financial modeling. And it's fairly logical. It fits together. There are very logical steps in there, which is what you would expect. So let's look at idu-Concept. So idu-Concept is a tool set that, obviously, as I mentioned before, is a web-based tool set. It has a number of modules. One of those is a financial modeling module. Obviously, it doesn't run in splendid isolation, but you probably need a budgeting module as well. The first thing that you do, as per the graphic I put up earlier, is to define a source set of data. Now, obviously, there's a lot of functionality in idu. I'm not going to go through all of it, but in a nutshell, a source set of data is defined in a screen like this with a couple of sub-tabs. The important things are a description. What is your source set of data? How many years do you want to budget into the future? Those are the key components in defining or creating your modeling data set, which is generated out of an original budget. Then you define those scenarios, and those scenarios you do part of the previous screen when you decide how many years, and then you start to define the assumptions. So in this very simple example, I've got inflation, I've got volume, I've got payroll. So those are three drivers which are going to impact your budget. So you've done a detailed budget. Now we're going to say what happens if inflation is X or inflation is Y. What happens if the volume of our business increases? Does the volume of our business increasing have an impact on sales? Does it impact on staff? What about payroll inflation? Does that only affect payroll? Does inflation affect payroll as well? Who knows? That's what we're trying to define here. So we can create as many assumptions as we want. And I'll come back to the last one, which is predictive just now. Once we define an assumption, giving it a name is one thing. Now we've got to go into the detail and actually identify month by month, although we do have a copy to all option, scenario by scenario, optimistic, neutral, and pessimistic, year by year, and go and put a driver or a value in there which actually pulls or is going to extrapolate the data in your source data based on those figures. And you would do this for every assumption that you define. The more assumptions you define, the more maintenance is involved, but the more accurate your ultimate model will potentially be. The next thing we do is we've got the assumptions and we've got our base set of data. Now we need to go through the accounts. So in this case, I've got group sales. It's a posting account, although I could do this at a summary account as well. And I'm going to look at it and say, well, what's going to impact my sales figure? Well, I think my volume assumption will impact sales. I think my inflation assumption will impact sales, but the salary one, that doesn't apply. So now I've linked two assumptions to that sales account. If I go to another account like salaries, maybe it's going to be impacted not by volume, not by inflation, but only by headcount numbers. If I take something like stationery, for example, and that's an interesting one because that's potentially going to be impacted by inflation because the cost of paper will go up. If you increase your headcount, you're probably going to use more paper, so that's going to increase. And if your volume of sales go up, that possibly will also affect the amount of paper or stationery used in the business. So potentially that could have all three actually applied to it. Next thing we do, having defined how accounts interact with assumptions, is we then take it down a level further and look at individual cost centers or departments or divisions, because you can do it again at a summary level, and decide, hang on a second, that's a valid assumption for that area of the business, but for this area of the business, I want to change the assumptions. I want to exclude that assumption from that particular account for that range of the business. So we start to drill down and expand or explode the level of granularity to which we can define the assumptions across the business. And then we hit the big button, we calculate the figures, and now we can get into a review process. Now, on the front end, so far what I've been showing you is what you would do in the administrator. That's what the accountants would do to define and to set up the environment. But on the front end, now you can actually start to look at the information. You can actually start to change it. if you want to. So you could change for your particular department the assumptions which have been applied to your base set of data. You could exclude some, you could add some additional ones, because you're at the coal face, so you potentially have a higher level of knowledge of what's actually going on in your local jurisdiction than you do at a lower level. You can also go down and look at individual values and overwrite values, because maybe it doesn't matter what the assumptions say, you know that next year this figure is going to change. So you can overwrite the assumption. Now, one of the problems with this is that if you let every Tom, Dick, and Harry go and change figures, you're going to lose control over how the numbers stack up. Obviously, we allow the user to change them, but the administrator can review all of the changes in a single screen, and he can choose to overwrite them, to reset them if he feels they're not valid, or he can leave them as they are. But you'll notice the highlighting shows you which fields have been changed. So you can see very easily and drill down and see what the impact of those changes are. And then if you don't like the numbers, again, back to rinse and repeat. Go and manipulate any of the individual areas or drivers that you can see to update and amend your budget. Hit the recalc button. Okay, that's how your financial planning or financial modeling can build. It runs fairly independent of algorithms. It runs fairly independent of any complex data. It's relatively quick to put in, very quick to put in fact, but it also lets you fly and push in numbers and generate new values very, very quickly. So as new information comes available, you can tweak an assumption, regenerate your figures. As more data comes in, tweak your assumption, regenerate the figures. See how the changes happen. Now, interestingly enough, predictive analytics is something that everybody has been talking about. A lot of budgeting tool sets are based on predictive analytics. So in other words, you put in a number and the system will generate what the budget is going to be for you next year based on history. Well, we've just brought predictive analytics into our system as well. I think our timing could have been better, because I would suggest that there's a good argument for saying predictive analytics are actually obsolete at this juncture. Why do I say that? Well, anyone who wants to predict next year's business levels based on this year's actuals is going to have a problem, because COVID-19 has made chaos of historical information. Any predictive analytics that you want to use for next year is going to have to exclude this period of time when we've been in lockdown. Otherwise, anything you predict based on these figures is going to be completely out of sync. So predictive analytics is an interesting one. I like the concept, but we're going to have to deal with it very, very carefully in the months and years ahead, because of this blip that we have called COVID-19 and the economic impact it's had globally. So how does predictive analytics work? There are effectively three variables that we've created into our predictive analytics. One is the number of history periods you want to actually build your analytics on. So you can define how many months you want to go back, how many years you want to go back, whether you want to use all the information that you have on your database, or you can limit it to the last 12 months. A training window you can also manipulate. Now, a training window basically measures the repetitive period. So if I want to have a history of 12 months, that could be one training period of 12 months. Or I could say, as far as I'm concerned, my figures replicate themselves every quarter. So I'm going to make my training period 3 months, in which case I'm effectively going to have 4 iterations of information to form and to customize my predictive figures and my predictive algorithms for the next however many months. And then you've got your confidence percentage, which obviously the bigger the confidence percentage, the higher the percentage, the less deviation you'll have, but obviously the more accurate you're going to have to be with your underlying data. What does that do? Well, that creates an extrapolation of where your numbers are going forward. Now, if these dates were realistic, perhaps this could be my sales figure covering the COVID period when I was in lockdown in March 17 or February 17. But as you can see, it's going to replicate that every single year, because that's what my history is telling me. Now you can see the red and the purple dotted lines there are obviously the good and the bad variations on that. And again, the standard deviation of that will be dictated by your confidence level that you have set. And then once again, we can review the results. And in just exactly the same way, we can actually go and modify the numbers if we have better knowledge at the coalface than we have elsewhere. So just to summarize, financial modeling IDU style, it is quick to set up. It's a very logical step-by-step process, therefore it's intuitive to use. Your user review and adjustment is available, as well as management, senior management, and finance review and adjustment. There is that admin override because, unfortunately, with financial modeling, it really isn't going to be a massively rolled out solution for everybody to put their finger in the pie. It is, by definition, going to be fairly localized and therefore limited probably to finance. The review, rinse and repeat is a very powerful way to continually fine-tune and amend the assumptions that you have. Your predictive analytics, as I mentioned, is in there, and it is configurable to meet requirements. So basically, we're giving you a composite solution built on the back of budgeting, but essentially a modeling tool set that is quick and easy for you to actually utilize. And I'm finished, so if you would like to take control again, Tom.
Excellent. Thanks, Kevin. That's fantastic. Thank you so much. We actually have a lot of questions, so we'll try and tackle as many as we can before the end of our time here with the group today. The first one I will throw your way. Someone was, it's more of a comment, but maybe you can comment on their comment. What they said, rolling forecast is the way to go. Kevin, what are your thoughts on that?
I think rolling forecasts it's been out there and it's been a discussion point forever. I can see the benefit in rolling forecasts because you want to continually be updating and seeing where you're headed. I also see a downside with rolling forecasts in that you struggle to get to the point where you can actually measure performance against forecast. Because if you're constantly changing the end goals, how do you ever get there to see whether you did or did not achieve your budget, your budgetary figures, your forecast figures? So yeah, I can see the pluses and the minuses. And rolling forecast effectively, if you think about it, a financial model or a financial planning model like we just went through is a rolling forecast because you're constantly updating it by fine-tuning your assumptions. Your base set of data could be a forecast set of data. That forecast set of data could be updated with actuals on a daily, weekly, monthly basis. So in effect, you could be constantly changing your underlying data, your base set of data, and you could be constantly fine-tuning your assumptions. So I can deliver the rolling forecast sort of concept within there. But as I said, I would, from a day-to-day planning or budgeting perspective, I think from a corporate perspective, it's very important to be able to say, right, your target is this for the year. And when you get to the end of the year, be able to measure whether or not you achieved that target. And obviously that hanging off the back of that is potentially bonuses and promotions, etc. In a rolling forecast environment, it's more difficult to actually tie that down because you get 3 months in and you change the end of the year figures. So you're constantly chasing something which is moving.
Excellent. Thanks, Kevin. Another question is IDU available on the cloud, and are there any differences in features?
We have exactly the same solution available on the cloud or on-premise, and we've designed the system as a solution which runs on both platforms, or in fact on a hosted platform as well. So there is the third option. There's the IDU Cloud, which obviously we manage through Microsoft Azure. Then there's on-premise, which is the other extreme. But in between, there's a hosted solution where, saying a lot of our very large corporate clients like to have their own personalized cloud, which is typically a hosted solution where a third party actually runs the servers and the information is kept on there. So, and all three would be exactly the same in terms of IDU.
Perfect. Next question is, how do you suggest forecasting projects in IDU? We can assume a % increase from last year for projects.
I'm sorry, to clarify that a bit, is there anything else on the question?
It sounds like how would you forecast a project? So, projects within the platform.
Okay, that's fine. Okay, so we basically can do, the nice thing about IDU and setting the budgeting module is that whatever you want to do in IDU can probably be done 3 or 4 different ways. And that's why it is applicable to any industry sector, because it can be morphed or set up accordingly. So to answer the project question, we have project functionality in the system, so you can actually go and set up budget projects. You can set up projects going 5 years into the future if you want to. You can set up projects which are not approved yet, and then you can actually approve them or unapprove them as necessary. However, interestingly enough, what we find most of our clients, when they want to budget projects, and if they're a heavy project user, we normally view a project as a cost center, because that does give you the benefit of having access to all the accounts that you need. And because it runs as a cost center or a profit center, depending on the type of project, you can actually accumulate everything in there and have profit and losses by project, as well as being able to report the actuals very easily in exactly the same way. So that's how most of our clients actually deal with it.
Thanks, Kevin. Another question is, we currently use Hyperion, but we're looking to switch. What would the migration process look like to idu-Concept?
We've got a lot of clients who, interestingly enough, we have quite a few clients who use Hyperion, but only for reporting. But we also have a lot of clients who have switched to IDU over the last year or so. Our product is a new product, and it's growing all the time. It's constantly being updated. Unfortunately, the same can't be said for Hyperion. So how do we integrate? Well, Hyperion being originally an Oracle solution, owned by Oracle. Typically, most of the clients we see with Hyperion run Oracle financials as a backend. That's a relatively open database, so we can interact directly with that. However, at the same time, what Hyperion extracts from Oracle is not dissimilar to what we would require, and therefore we're actually able to piggyback or hijack the extracts of data that you already have for Hyperion and utilize that. And certainly in instances where clients are running multiple ERPs or non-Oracle ERPs, we use exactly that as the easiest, quickest source of data. It saves us writing new interfaces, and we can simply leverage what's already been created. So we would look at what's there already, tweak it, and bring it into our system, into our platform. What we find with the large global companies that use IDU, but also use Hyperion, it's often a case of the head office sitting in Detroit or New York or wherever, the global head office. They want a single view of their reporting across the globe. And they use Hyperion for that because it's very rigid, it's very structured. And that's fine for head office. But when you get down to the actual operating business units, the operating companies scattered around the globe, it really doesn't fit them. The income statement doesn't suit their business. The balance sheet isn't relevant to them. And what we find is they use IDU to deliver the localized information from a reporting and budgeting perspective. And then they also push it. We would simply build a structure in IDU which reflects the Hyperion structure, the required information, utilize that in the export, and we then populate Hyperion automatically from within IDU. So we quite enjoy the Hyperion environment, either as an environment where the client isn't going to change, but more importantly, when they are about to change, then we certainly look forward to that, and it's a relatively quick process.
Thanks, Kevin. Next question is, are P&L, balance sheet, and cash flow automated?
Yes, they are. Just to clarify, we don't, we can deliver sort of IFRS GAAP type income statements and balance sheets, which we do through one of our partners, a crowd called DraftWorks. So they do I think they do US GAAP as well now, and IFRS for the rest of the world. But our focus as IDU is actually really more at the board level and looking downwards into the organization, in other words, management reporting. And so we can give the departmental managers an income statement for their department, which they can relate to, click on, drill through, right the way through to individual transactions, in fact, even images of invoices, if that's what they want, without having to access the ERP solution. So we can do that, and that's how we really focus our system. We can then link the P&L, certainly in budgeting, to respective balance sheet accounts. And by so doing, we can auto-generate most of the balance sheet Obviously, there are certain accounts which don't get driven from the income statement. So share capital, long-term loans, long-term indebtedness, that sort of stuff we can't populate. We can populate fixed assets because we do CapEx budgeting. We certainly populate the debtors and the creditors. And then we can set up cash flow rules within the balance sheet to actually say, well, our debtors will fill into cash after 60 days for these revenue accounts, 30 days for those revenue accounts. And therefore, by doing that, we can deliver the cash flow as well. So we can give you cash flow reporting, we can give you balance sheet reporting, and definitely we do income statement.
Excellent. Thanks, Kevin. Next question is, what ERPs sorry, I'll have to rephrase that a bit. What ERP systems does idu-Concept integrate with?
Okay, we're fairly agnostic when it comes to ERP systems. We're not a SAP budgeting tool or an Oracle budgeting tool or a Great Plains Dynamics budgeting tool or Sage, but we are a generic tool set that sits on top of any of those ERPs. I think at last count, we had 37, 38 ERPs that we sit on top of. Most of those, the vast majority of those, we integrate with using what we refer to as SSIS packages, which are SQL software integration services. And that allows us the flexibility to make every integration unique to the client. Obviously, we can hijack the bulk of an SSIS package for Dynamics for one client and take it to another Dynamics client. And all we have to do is fine tune the output effectively. So it is relatively quick to do, but we prefer not to have static integration with individual ERPs because one, they change, and two, every client has got unique requirements in terms of the data that they want out of the system. So the answer to your question is, as long as we can get at the data, then we can integrate with it. When we can't, and the one exception is obviously SAP, we're not actually able to integrate with their database, so therefore we normally get an extract from their database by programmers, or we integrate directly with the business warehouse, SAP BW.
All right, so we're running out of time. Maybe I'll throw out one last question to you and we'll wrap up. Next, it's a fairly timely question, is can you implement remotely?
Yes, we can. I'm sitting in South Africa at the moment. You're sitting in Canada. We've got clients from New Zealand to Canada. Our clients in Canada are in some of the most remote places on the world, and the bulk of their implementation has been done remotely. We would normally like to do our training face-to-face, but given the COVID restrictions, we've actually been doing that via Zoom or GoToMeeting sessions now as well, and that's worked very well. Plus, we also have a fairly extensive catalogue of online training as well, which have been videoed and recorded. So we can do even the training remotely now.
Excellent. Thank you so much, Kevin. So obviously we're at the end of the webinar. There are still some remaining questions outstanding. We'll make sure to reach out to each and every one of you who your question might have not been answered yet. So don't worry, you'll get a personal response from us. And with that being said, thank you everyone for joining. To learn more about idu-Concept, go to www.idusoft.com. And feel free to contact us to book a free one-on-one review or demo of idu-Concept. My contact information is on the screen right now, so please feel free to reach out and connect. And with that being said, Kevin, thank you so much. That was an excellent webinar. Thank you for your time, and we'll wrap it up.
Thanks a lot. Thanks for joining us. Thanks, Tom.
Thanks, Kevin. Cheers.